It was a complete bloodbath on the markets today, a day of collateral damage. On the last trade, the Sensex tumbled over 800 points and the Nifty fell below 5,500 levels. Now, the carnage across equities today, over 4% fall for the benchmark indices. Rupee broke below 62 to a dollar. So that was the kind of carnage, and we'll take each one of them one by one. Let's take it straight across to ET Now stocks editor Nikunj Dalmia joining us on the mayhem that we had seen in the markets. Nikunj, good to have you on the show. Of course, there was cracks all across the asset classes, but equity markets really saw the worst fall, worst since July 2009.
It was a perfect storm of all sorts. Everything came together. Nervousness about capital restrictions, bad global cues, weakness in rupee, big spike in bond yields, and that really accentuated some degree of institutional selling. Nifty may have fallen by about 4% plus, but this market surely has rediscovered pronounced downtrend or pronounced momentum on the downside. Stocks like HDFC Bank, Infosys, TCS, stocks which are dominated by institutional investors, they really led the market down. So just like a rising tide takes everything up, today it was a falling tide or a receding tide. And to give you an example of how strong the market nervousness was, look at the IT index, which today took a knock of 2% plus. Now, this is an ideal environment for IT stocks because IT stocks will benefit because of weakness in rupee. But today, the IT index also took a knock of 2%. So, in general, I guess there is some degree of nervousness. Institutional investors know that the trade has got reset, growth expectations have got marked down, and suddenly everyone is running for cover and there is no space to hide. So you can't blame it on a single factor, but unfortunately the force with which Indian markets have fallen today, I guess in the near term, the trading regime for Indian equities at least has changed.